to get to. Rob, where are you at today?
Where I be?
Where you be?
I'd be in Northern California, in Marin County, in San Rafael. Bill, where are you?
I am in upstate Minnesota, in between Bemidji and Hibbing and Duluth, in a little town called Grand Rapids, where my wife is from, and we've lived here in the summers for 30 years or so.
Well, summer is winding down, so are you getting
Mhm.
ready to go somewhere else?
Yeah. Then we'll like most people my age now, we're chasing 70. So I'm heading to 70 degrees, which maybe by the time I get back to Vegas, it'll be 70, because it's been 100, for the whole summer. So it's like we just avoid that during the summer and live here, which is great.
Yeah, the weather Midwest, September. I was just talking to my girlfriend about it. It's so awesome. It's my favorite weather
Yeah.
month where I live by far. I mean, it's been just 70 to like 80 every day, not a lot of rain, leaves changing, kind of cool in the morning and the evening. And, you want a little sun, you can get that too in the afternoon. So it's a good mix.
Yeah, it's like Rob and I get used to, living in California, coming from Ohio. You guys are like my bookends. Born and raised in Ohio and lived in Northern Cal, for 40, so started First Franklin and San Jose. So, and there's people that, like Rob, people that have not spent any time in California, love their seasons and love everything, but there's nothing like California weather.
It's true. All
Because
right.
it's all the time.
Yeah. All right, let's go ahead and get into it. I'm Rich Swerbinsky with Onward and Upward Consulting. This is The Big Picture. Thank you for joining us. And as always, pleased to be joined by esteemed colleague and co-host, Rob Chrisman. Rob, good to see you today.
Nice to see you too.
And this week, very pleased to be joined by a special guest, repeat guest. Did a great job last time he was on, got a lot of nice comments. We wanted to cue Bill back up before the election madness comes to a culmination, but a guy that really needs no introduction. I'll give him one anyway. Led a bunch of companies in this space, including First Franklin, Finance of America, CloudVerga, now running his own consulting firm, Dallas Capital. It is Bill Dallas. Bill, great to see you, and thanks for coming back on the show.
Thanks. A lot to talk about today, huh? Yeah, it's going to be fun.
So much to get into. I'm excited. We got obviously the Fed move and some election policy stuff and some Fannie Freddie stuff. And we always like to pick Bill's brain as well on just what he kind of sees in the landscape for the independent mortgage banker and trends and keys to success moving forward. So we're going to touch on all that today. But Rob, got to start with the Fed, I guess it wasn't really a surprise move. The sentiment shifted over the course of last week. I know on the show last week, it was still about a 65% chance of a 25 basis point cut. And that sentiment started to shift. And sure, you'll have it that, 50 basis points from the Fed yesterday. Jerome Powell making the more aggressive play that we didn't think he'd make when we were talking about this last week, but he went ahead and did it. Of course, in the wake of it, some people crying politics, some people crying and playing catch up. What did you make of the move yesterday, Rob? And we'd just love to hear your thoughts on the Fed's action and statement yesterday.
I didn't know we were going to be talking about the Fed today, Rich. I thought we were going to be talking about the price of gold. So I did all kinds of research on that. I thought that's what we were focusing on. But since you brought it up, the Fed. Well, that's old news now, right?
Mm-hmm.
Can we talk about something else? Bill remembers the days when the Fed wasn't in the headlines every day. You can't tune into a financial news show, whether it's Bloomberg Radio or CNBC, without like in a 10-minute span somebody talking about the Federal Reserve. And wouldn't it be nice to focus on other things like other things? But here we are. We're still talking about the Fed at this point. They made their move, and 25 or 50 basis points. They decided to make a preemptive move higher. I'm sorry, lower. Rates actually went up yesterday. I
Mhm.
think they're up again today.
They're up today.
And
Yep.
as I said in my commentary, it's a classic buy the rumor, sell the news, or sell the rumor, buy whatever it is. The market was ready for some kind of move, and here we had it. And then you're right, there are people who are politicizing the move, as we knew that they would. Anything that happens within like 6 months of an election now, somebody will say, well, that's politically motivated, which is unfortunate, but that's the kind of environment we're in. But yeah, I mean, the Federal Reserve has done a very good job of telegraphing what they're thinking, what they're probably going to do. So it wasn't a surprise. And so it's almost as if, okay, well, now we're done with that. Let's move on. What's next? What can we talk about next? When's the next inflation data? When's the next employment data? And has the Federal Reserve's focus shifted maybe from inflation, now that we're kind of close enough to 2%, 2%, 2.5%, 3%, maybe we're shifting now to unemployment and trying to bring unemployment back down. So, I mean, there are critics. I mean, Rich, you've been very critical of the Federal Reserve. In fact, I think, don't you have a bumper sticker with Jerome Powell with a red line through his name or something? Anyway, I think the Fed's done an okay job. There's always going to be critics, and there's always going to be people looking in the rearview mirror saying they should have done this or they should have done that. But I will say, and I was going to ask Bill to address this, it's not that the Federal Reserve doesn't matter, but as my years have gone by, and I talked to plenty of originators and owners of companies and brokers and all types of people, the Federal Reserve is fine, but successful people are focused on what they're doing, not what the Fed is doing necessarily, but what kind of programs they're offering, what kind of services they offer, what is their reputation like, how can they help their borrowers? And so, yeah, the Federal Reserve did what it did. But Bill, I wanted to ask you, I mean, is that what you see as well? The successful, savvy, entrepreneurial business people out there. I mean, they know what the Fed is doing, but they are focused on providing services and products for their clients and borrowers.
Yeah, I think the two comments. One is that, yeah, I see more focus like you do. If I go to an event, I'll hear loan officers talk to clients, or they'll be on a Zoom call, or they're doing some consultation, and the whole conversation is around rate. And of course, I think interest rates, they matter, obviously, but it's directionally where you are in that cycle. And as a person that runs and have always run a mortgage company, it's a series of pivots, right? And there's interest rates going up, there's interest rates declining, there's interest rates flat, right? And what's interesting about this move is the last three times, there's only been three when there's been a 50 basis point move. One was in 01, which is the bubble, the tech bubble. One is 07, 08, which is the Great Recession. The others, 2020, in the pandemic. Those are three pretty big events to get a 50. So what I keep asking is, what's the catastrophe that's going to happen now? Because you either see a catastrophe or you don't. I think the headline is rates are declining, albeit the 50 was already in the market. And that's what I've been telling everybody, is it's going to be bumpy coming out of that. But I think now your pivot theme has to be, how do you align your business? I mean, if you are a great mortgage banker, you're a great lender, a great loan officer, you're trying to align your business now with the tide. And this pivot is to declining rates. So are they going to decline bumpy? Are they going to, there's nothing worse, I think, for a loan officer than interest rates. Everybody knows interest rates are going to decline because they'll just wait forever. A client will never make a decision, right? It'll be terrible. And I think though, the pivot is there, but much like in 2020, 2021, while we're booming, I was only talking about the pivot of 2022. When we move out of, when interest rates go up, what are we going to do? Because you have to prepare for that way in advance. And then it takes a long time for you to actually make it happen in an organization. Now for lenders, I mean, if you're trying to pivot right now, you're way behind the curve, right? Because you should have been, declining rates are going to happen, albeit slowly. And I think those are the things that great leaders and great originators and people in the business who are serious about it. I know with my clients, all I've been talking about this year is staying focused on the main thing, making sure you're operationally excellent, making sure that you've got some strategy for ESG and what's happening in the world, right? In terms of aging, whether it's aging in place or whether it's what you see in terms of maintenance and utilities and water costs, catastrophes and weather and wind and solar and all these things that are collapsing on what I would call the maintenance side of mortgage, not the PITI, but the MU, maintenance and utilities, which is going to be big. You can say it's ESG, but it isn't. But how do we then stay focused on the main mission, which is helping our clients reduce their rate, reduce their debt, manage their wealth in real estate, right? That's the business that we're in. And sometimes, like you said, Rob, it just is, people get so focused on interest rates, it doesn't matter, right? Just be focused on your business and run it well and help your people understand that this pivot means you've got to really align your business for a different future.
Yeah, it's like I liken it to things like blood pressure or tire pressure or something. It's a number. Okay, what's your blood pressure? I mean, it's an easy thing to talk about. What in the old days used to be, what's your G fee? Well, my G fee is this. I used to hear people at the car, my G fee is this. What's yours? Mine's that. G fees are easy to talk about. Blood pressures, the number is easy to talk about. Tire pressure is easy to talk about. What's harder to talk about is, why is your blood pressure whatever level it is? Why is what's going on with your tire wear? Why is your G fee that? And now, interest rates are what they are. They impact everybody. But yeah, what are you doing about it? There's trillions of dollars of wealth out there, of home equity. What are you doing about it? Well, I don't know if they're trillions, but whatever the number is, there's a lot of home equity. What are you doing about it?
Yeah.
What are you doing about calling on builders? What are you doing about this? What are you doing about that? Rates are doing what they're doing, but let's get on with it. So not to diminish, Rich, from your question about the Fed, because it is interesting what they did and why they did it. But now it's like, all right, what's next? Well, let's get back to business. Let's roll up our sleeves, help our borrowers.
3 years of a bear market, more emphasis. People are just, it can only, without rates lowering, business can only accelerate so much. So I think that is part of it. This hyper focus on the Fed right now, that I would agree with, has been kind of crazy. It's just been such a long bear cycle.
I think making them rock stars. I mean, I love that ad that you see where everybody's a rock star. I mean, why we're at Jackson Hole? A, why are y'all there first? 2, who gives a shit? 3, right? It's like, really? We're talking if you want to talk interest rates, and get on a subway and be with the masses of the people who are on a subway, and now talk about it. Mm-hmm. But don't be talking about it in Jackson Hole, Wyoming. It didn't seem possible to me, right? Why are we doing this? And I think, like for you and I, the focus needs to shift. If I'm a loan officer or a mortgage company, right, the focus before, what I always tried to do is I focused my loan officers on how to really originate non-rate sensitive loans, because rates are going higher. Now I've got the decrescendo. So now how do you focus on the skill of originating rate sensitive loans? Even harder in some respect, right? So, and I think products, all that stuff, it's just so interesting for us You know, we sort of nibble on the edges of everything else, right? ESG, AI enabled, digital, tech, all those things that are important. But we're in the in triplicate, sell the loans to the government world, right? So we're a little different, and all those things, like you guys said. I mean, we could talk about Fannie and Freddie. Are they going to be private? We could talk about Fannie and Freddie. What's going to happen? I think you can talk about tech. You could talk about tech enabled. All those themes, if you're running a business, you have to align your business around the future that you believe in. And then how do you make that happen, right? Which is what I spend all my time trying to help people to do, is just think about it, right? And I know in navigating my own business, always, and Rob and I used to talk about it in his prior life and in my prior life. And it was always, I don't care what's going to happen, another shoe is going to drop in my business. And that shoe generally hit me right in the face. So I have to be able to be ready as a mortgage company for both feet. And it's not easy, right? It's like, it wears you out.
So Bill, what are you advising or seeing clients do in terms of being ready? What are a couple concrete things that folks tuning in here can say, oh, yeah, we should do that?
Yeah, I think there's 4 things, right? One is your mission and making sure that you're clear on your mission. We help people now we're going to help people reduce rates, use your cash wisely to build sustainable wealth. So stay focused, right? I think focus on the skill to originate loans in rate sensitive cash out environment. This is not what agencies do well. They hate cash out, right? They don't like other properties, right? They like single families, right? And you're sitting there, and they don't like high LTV purchases. We're going to a high LTV purchase, cash out, refinance market. So you need skill and products. I think the third is improving efficiency. I've never seen a fatter, more ugly group of people in the mortgage business. It's unbelievable how fat. I mean, you could be doing a FHA DPA and your margin's 105.50 and you're losing money. Right? And I think you're not retaining an asset. The problem with mortgage banking is you have to retain an asset or you don't build any value. And then I think the final is a focus on more than just agency products to align with this future. Because, purchase and affordability is what the agencies talk about. I think you got a gift. I mean, you already saw interest rates. You already saw a couple people pre-announce the conforming limit change. The one, I think it's 802,650 or something like that. Hey, Rob, what was it when you started? When I started,
20,000. Who knows? Right.
The last time I see a data point is 1980, and that's when I started. It was I think it was 93,750 or something like that. $93,000. So I think we need to be ready for rate sensitive. We need to be ready for purchase and affordability and high LTVs. We need to have investor loans because it looks like houses are multi-use things suddenly, right? They're not just a home. You rent them, you office in them, you do a bunch of stuff. You need non-agency because that's where all the cool guidelines are for people that don't qualify. You need HELOCs to pull money out. You need reverse because people are getting older by the second, including me. You need HEI contracts, right? Which give you the ability for equity sharing potentially. You need HI, you need home improvement because none of your shit's working in your house, right? Suddenly the lighting needs to change. My heating's terrible. My roof is, America's stock of housing is getting old. Rich lives in an old place. San Rafael and Fremont, it's still on the efficient curve. And then I think there's cool things like ADUs and other things that are pushing the market to solve some of these issues. But those things I think are what I see. How do I take those 4 points, mission focused, focus on the skills of all these products, stay focused on improving my efficiency and lowering my costs, and then focus on the things that are going to help me take cash out and do high LTV purchases, which is going to be the next year. And then, are we going to create a credit bubble? Yes. You know why? Because that's what we do in mortgage banking. Eventually we go to the dark side, and we've gone way too far. This time it won't be fraud probably, and it won't be NIV stated and all the things that were done before by all of us. It'll be something else, right? And you already see it a little bit. I'm going to jump out here. People will slap me, in a product called DSCR, right? It's already fraudulent. It's multi-purpose, blah, blah, blah. Everybody likes it because you don't have to do anything. You don't have to comply with anything. And you get a higher rate. So I think,
that said, Bill, as I understand it, I don't sit there and look at rate sheets every day anymore, but you mentioned the DSCR loans. Yeah, that is a bit of a darling in the non-QM world in terms of when you look at those rates for non-owner, investor loans versus agency. I don't know if there's much difference now. I mean, that spread has come down, so it's attractive to originators right now.
Yeah. I mean, since I started, it was a primary occupant, owner-occupied world with one borrower with one FICO. You couldn't even put the other person on the app because you didn't know where to put it. I mean, there was no multiple occupant co-borrower, usage issue, right? And single families today are multi-use properties, and that headline hasn't gotten to the government and hasn't gotten anywhere. So we bang up against all these guidelines, and you've got all these people who have Airbnbs, you've got all these people who are doing VRBO, you got people renting and roommates and stuff and officing and all that. That's been going on for a long time. But obviously the biggest amount of fraud in mortgage banking, and it is always about occupancy, right? And income, sometimes assets, right? But generally you could take 70%, throw a blanket over 70% of the fraud. And so what's happened is now you're going to take cash out of properties that are mixed use, and that isn't what the agencies do. So you best be on your horse and be ready, because your products and things have to be different. Like you said, Rob, when these rates converge like they have, right? I think the other thing I tell people is you're going to get used to another non-QM thing, right? You're sort of getting used to HELOCs and underwriting guidelines, but you're going to get used to IOs. And interest-only loans are going to show up because the yield curve is getting de-inflated. I mean, and when that happens, a 3 and a 5 and a 7 and a 10 are going to be a lower rate than a 30, and you're going to need those. And it's already happened in banking. I would say 70% of the loans that I've seen at US Bank or Wells or different places are some intermediate bullet. A 7 that rolls to a 1, rolls to a 10 or something like that. So I would say products are important, but making sure that you are in lockstep. You've got to make sure your company is in lockstep and with what's going to happen. And consumers blow their money and blow their equity. That's what they do. That's their job. They just spend it. Life takes it. Everybody's got it. They lose it. They get divorced. They can split it in half and give it away faster than going to Vegas and putting it on red, right? They'll build something stupid, start a business, give it to a kid. I've never seen anything like it. So our job is to say mission driven, lower their rate, teach them how to build sustainable real estate wealth, which is not blow the money, because they got records of it. This could be historic if they don't blow it. So our job is, I think, mission to me is just making sure that when you have, like when I sold First Franklin, I went from no value and a lot of value to cash. I knew nothing about how to manage cash. I knew about one sentence: don't lose the money. Right. And so today, my number one strategy with all of my clients is DLM. Don't lose money. Why? Because if you don't lose money, you have options suddenly. And so my fear is that we will not do this well. And our partners, the agencies, their FHA obviously is pretty good at high LTV lending. Fannie and Freddie hate it. They're not good at it. And they like high FICO. They like low LTV. They try to cream the crop of the great loans. They hate cash out. They don't like non-owner. They don't like second homes. I mean, so all of those things are going to be thrown up in the air suddenly. And if you want to be honest and do the right thing and originate the loan properly and all that stuff, you're going to have 27 things in your holster, not one, which is going to be, I think, a big change for people.
This is the Big Picture. Rich Swerbinsky with Onward and Upward Consulting, joined as always by Rob Chrisman this week. Really pleased to be joined by Bill Dallas of Dallas Capital. And good segue, Bill, because former FHFA director Mark Calabria was interviewed the other day and made some comments that, I guess got some attention. I don't think there was anything surprising in there, but basically said in an interview that if President Trump is reelected, former President Trump is reelected, that he would once again look to privatize the GSEs, as Calabria was kind of doing for him his first term. And basically said no chance of it happening in 25, but he said there was about a 70% chance of it happening by 27. And then, went on to point to all the work that he did for years on this mission, and kind of stating that the framework is there. A lot of the work's already been done. A lot of the stuff that can be kind of picked up and reused, and it's very interesting topic to me right now, just in our industry. Certainly with the election coming up, a lot at stake in just the country in general, but in our space certainly. CFPB's future, what that'll look like, but most notably Fannie and Freddie, which will look dramatically different a year from now, depending who wins. Former President Trump wins, very likely to see him do what Calabria just stated. If Vice President Harris wins, likely to leverage the GSEs more, to your point about kind of the fear of maybe going a little bit too far. She's not talking about expanding guidelines yet, but she's talking about tax credits for low income, tax credits for builders that build and sell to a first-time home buyer. She's talking about creating a $40 billion bribe fund, essentially, for people that local municipalities that change their zoning, to things that are conducive to more affordable housing, and other things. So just curious on both your thoughts on just the GSEs in general, and kind of what's at stake here with the election, and maybe some things that are likely to happen of note if either side wins. And Rob, I'll start with you on this one. Fannie, Freddie.
No, let's start with Bill.
Okay,
More
Bill,
interested in
start
hearing
with
what
you.
Bill has to say, and I think that's why.
I was itching to trump you on that one, Rob, and just go off, but no pun intended. But I think all the accoutrements of what Vice President Harris is talking about is already in the market, right? I think zoning laws zoning is changing. Everybody's focused on affordable housing in almost every municipality that I'm in. They have also a homelessness and a homeless problem, which is another issue. And then I think if you would look at mortgage bankers, you can't find a mortgage banker today that's not doing 20, if they're of any weight, not doing 30 or 35% of their business with FHA and DPAs, these down payment assist programs, which are all giveaways, right? I don't think you need more giveaways. or more tax credits. I think we need guidelines. We need to modernize the guidelines so people have more income, because their income has changed so much and they can't count it. So the number one challenge in mortgage are guidelines. And so I say I'm apolitical. I'm probably socially a Democrat and fiscally a Republican, right? I don't care. I just know. And Calabria, I mean, he is, I think, wasn't he, Rob? Isn't he the first FHFA commissioner ever? I mean, I don't even know that did we have a FHA?
I thought we had one.
Yeah, there was a couple, I think, before him.
DeMarco?
At the end of the
DeMarco,
day,
Ed DeMarco.
FHFA's only job is to manage Fannie and Freddie, right?
But I think Bill, he stands out in people's minds because he was he was very anti Fannie Mae and Freddie Mac coming into that job.
Mhm.
Yeah.
And people said,
It was
what
like
the heck?
his mantra was to put them on the shelf. And look, as a mortgage banker, you need Fannie and Freddie in times of distress, right? When the market goes south in March of 2020, I mean, look, in my career, it's probably gone south 3 or 4 times, where you really need to have liquidity and the non-agency market or the private market isn't there. They just run for the hills, tell you to pound sand, and you're stuck with all these loans, right? So I think there are moments in time when we need the federal government. I actually think that you're probably better off privatizing Fannie and Freddie and keeping one, whether it's FHA and VA through Jenny, something. I think there's probably a pony in there somewhere, but at the end of the day, our industry is agency centric. The whole industry is built around, desktop underwriter and LAS and systems and processes that are used to trying to figure out how we offer a 30-year fixed. I mean, I've never seen an industry that has one product that can do so many different things with it. It's almost unrecognizable by the time we're done with it. I mean, we can underwrite. How I could have 500 investors in Optimal Blue? It doesn't make any sense to me. I got one loan product, a 30-year fixed rate loan. We're like the stupidest people on the planet. If we can't figure out how to, we got MSR pricing, we got this, we got all these different things. This isn't even, we don't have G fees anymore, and our LLPAs are all the same. So I don't get it, right? So if you want to differentiate yourself in this business of sameness, it's very hard. So with the agencies, I think they sort of lull you into a false sense of security. And what my view was at First Franklin and at Own It and every place else is you always have to be ready for the non-agency, thing. And because I was in California, home prices were so high in our main state that we always had to be able to deal with jumbo non-agency, right? If I'm in, some of my clients, they're never going to get to a loan that's 802, right? It's just not going to happen. So now on the flip side, the whole world's changed, and they haven't. They have not changed. Those guidelines are 100 years old. So, and we're spending more and more time trying to give clients income, and it's getting kicked back faster than we can even come close to it. I mean, the other piece of this is how underwriters can only do 2 loans a day is beyond me. We have one product, one set of guidelines. Really? Right? What's taking so long? Well, the consumer doesn't fit anymore. It's over. The property doesn't fit, the consumer doesn't fit, and we're trying to line them all up like we did in the old days, where they were all working at GM, right? It's like I got clients self-employed, employed. I got 5 co-borrowers. I've got family members working. I've got I got a VRBO income coming in. I do some consulting on the side, so I make a little dough over here. I own a little hot dog stand on Thursdays that I do. I can't count any of that. So the problem is underwriting. And we've got to modernize it in order to, because you can't digitize this shit. I mean, like I said, when I started at CloudVerga, we were trying to make sure that we could actually get a loan faster. Well, you know what happened? Loan officers do 2 loans a month. They don't have to go that fast. Now, the call center guys, they go faster, but they basically don't do anything except when rates died. So I think at the end of the day, we have got to prepare companies for a different future with multi-products in a different set of underwriting. Because if anything that non-agency has taught me is that that's where all of the efficient guidelines go, right? And if you really want to get out of what you do every day, go do a HEI loan at HomeTap, right? It's an equity share. How much equity you got? You know, we'll give you a partner. We don't care what your FICO is. We don't care what your income is. You got a shitload of equity. Here you go. Right. So those are your 2 extremes, the government on the left and HEI on the right. And we sort of traffic in the middle. And some of that, like reverse. I don't know why reverse. I mean, my old company, Finance of America, sort of dominates that space, loves that space. I don't know why it doesn't pick up more steam. It's probably the safest thing for a person over 62 to do. Then there's other products and other services that sort of fit in between. And I think mortgage banking has a tendency to focus just on Fannie and Freddie. So if they go away, I really don't care. I would sort of prefer they go away, but then it scares the shit out of me. Like when it's like my safety blanket. What do I do if they don't? Now, if FHA went away, that could be a problem. Now, if VA went away, that's a problem for veterans, right? So, and those are no money down, low money down. And then if you go to any mortgage banking company in America, there's 2,500 EPA programs suddenly. So, and those are a problem, right? They're a problem to originate. They're a problem to maintain. And they're hard, and they're all over the place. You got a couple that line up that seem to be similar, but in most cases, it's very hard. So I think my view is the 30-year fixed rate loan is going to give way to an IO first. And then because you're at the tippy top of affordability, how are these people going to qualify to buy their home back? I mean, they've all changed jobs or they work from home. Shit, I don't even know where some of these people work, if they work at all, right? And so, and they've probably got 5 different sources of income that I can't count. So the one thing I've said is mortgage is very good at counting your obligations, and we suck at counting your income. Hop on board, right? Yeah. And so I think that's my view. So if, I do believe it is not going to happen because they make so much money at Fannie and Freddie that we could pay off some of the other stuff that where we lose a bunch of money in America, right? These guys print money.
They're making so much money. I mean, and I feel like, you know, this obsession with preparing to exit conservatorship has made Fannie and Freddie so conservative. Over 70% of all loans they write, low FICO, above 740. And to your point, Bill, about the underwriting guidelines not changing despite the gig economy and just the way people earn income completely changing. And then now I just think with the loan level price adjustments and where G fees are for every lender in America right now, it's so expensive. They're making so much money off the backs of American home buyers that, you know, I just feel like it's, you know, once volume starts to accelerate a little bit, the private market, I think it's going to be right there with Fannie and Freddie. And
I think so. And banks banks I mean, like you and I, we just from 08 till now, banks had about a 50% premium in rate, right? Because their funding cost is lower, blah, blah, blah. But at the end of the day, that's all gone. Banks are gone. Basel III's, they're running for the hills because they don't want to have to reserve all this capital as a result of just doing a mortgage loan. And they don't want the toxicity. They'd rather do a 30-year loan and keep it than they would to sell it to Fannie and have this plutonium that could come back to hit them in the future, right? So I think that premium is gone in the non-agency market. And for the first time, I've seen non-QM trade through not jumbo, right? And so what's that telling us? There's so many people in America that want to invest in SFRs, in single families. Yet all that is taken by the government.
Yep.
So why wouldn't you? I think with insurance companies now being almost able to come into the space and buy, I mean, you see in all these hedge funds, I don't care whether you were at Blackstone with me or you're at Athene, Apollo, Carlyle, it doesn't matter, pick them, right? Centerbridge, they all have insurance subsidiaries that are offshore, and they first figured out how to invest in reverse. They've also figured out how to invest in equity sharing, and they're figuring out how to compete in agency or in what I'm going to call normal SFR. I think to the consumer, it's not a good, I mean, the consumers have sort of learned to live on a 30-year loan amortization, right? Which, all things being equal, I mean, coming out of the Great Depression, how did we get to a 30-year loan? Well, the government owned all the property. We had to give it back to them, to the people. So we had to figure something they could afford. Well, 30-year has been around now forever. So that's going to be hard to change. Although, as you see with lower rates, people immediately go to a 5 or 7 year. And that's where I think your next big product is going to be an IO, which is, by the way, by definition, a non-QM loan, which I just eliminate the non-QM component altogether, because that's where the only place where guidelines make any sense are over there.
Yeah.
Right. So I don't know. I mean, I think for people now looking, so one of the things that I worked with Total Expert on, a marketing company that my daughter works with, they'd asked me to talk a little bit. And I said, look, what most people do with their equity is they blow it. Wouldn't it be nice if they figured out how to build an ADU in the backyard and solve affordable housing one person at a time? And, oh, by the way, increase the value of their home, get some rental income, and solve some problems. That seems to make sense to me, right? Versus, hey, let's put it in a pool. Or let's take a 3-bedroom and turn it into a 2-bedroom. Or let's take a house and makes it totally functionally obsolete by enclosing the garage in Minnesota in the middle of the winter, right? It's like, okay, who are you people? And what have you done with anybody who can make any normal decision about what to do with your equity, right? So I think mortgage people need to be on their horse. They really need to pivot, and they need to be ready for this market. And I don't think they are. I think they're lulled to sleep by agencies.
Certainly some valid points there. Rob, any thoughts on Bill's view?
Rant. Rob's like, I've heard this before.
I think we're out of time.
Oh my God.
Conveniently,
Can
yeah.
you believe that?
Well, as always, though, yeah, fascinating discussion, a lot going on. Certainly a lot of valid points about the GSEs.
I will. One last thought before, I mean, we are out of time, but Bill, I tell people, if you were to go to an island and design a mortgage, a home loan system, it would not look like ours.
No.
You know, ours has been basically almost thrown together piecemeal based on what's happened over the decades. You know, FHA and the VA and Fannie Mae and Freddie Mac and non-QM and I mean, just everything that's been thrown into the mix. And we have remnants going back a long time. But if you were to start anew from scratch, zero, it would probably not be, you know,
No.
exactly like what we're dealing with as an industry. So
No, and I think I agree. You sort of look at it like the offshoots of things that you see, like home improvement loans, you see peer-to-peer lending, you see consumer lending, you see all these folks doing just, fix and flips, investor, put it in an LLC. I mean, all those things are just telltale signs that we've sort of outgrown our system. And I, for one, want to give, Frank Raines, when he was in charge of Fannie Mae, said something that was it's always stuck. It stood the test of time and it sticks with me. And this is a commodity and we need to customize the commodity so it fits each individual consumer. So that when a consumer sees the guidelines, the consumer sees themselves in the guidelines. And that is not happening. It hasn't. So consumers look at the guidelines and go, shit, I can't qualify. And the broker then runs around trying to figure out, well, one of my best jokes always, you want to do a loan at a mortgage brokerage, then just look at all the stuff that's face down on the file on the opposite side that you're not supposed to show anyone, which would be their tax returns, their W-2s, their paycheck stuff. People just avoid that. So I would rather be upfront and open, but have if you're a teacher and you've got 3 months off, there's a guideline for you. But this isn't that hard. This really isn't. We're in the real estate business. We should be able to count all your real estate income. If you have 5 jobs, bring them on. Let me count them. When did you start? Did you just start? Great. Here, I'll count it. No. If you say you started a new job, what happens, Rich?
I just went through it, because, going from a W-2 job to starting 2 businesses, and I can't do shit.
Can't qualify.
Yeah, exactly.
No.
Yeah.
I got tons of equity. I can't qualify. You're suddenly thrust into the shithole of non-QM. Right. And then everybody talks about non-QM like it's like, oh, we're going to go back to, I've got PTSD with subprime. Are you kidding me? That was all fraudulent.
Yep.
This isn't fraud. This is just trying to use your income. And your income now comes from 7 sources instead of 1. And I think a lot of those sources, in my view, this is going to be me, I'm off on an island maybe, but in my view, a lot of those sources are more important than your job. Because I can guarantee you, if I can rent the bottom part of my house for $2,000 a month, I can always rent the bottom part of my house.
Mm-hmm. Right.
And my job can come and go. I could be fired tomorrow. I don't even know why I asked people for, a verification of employment. Are you kidding me? So I think we've got to figure this out. And you're going to have an opportunity right now because with home prices here, loans will be going up. You'll be touching the tippy top. You're going to need all income to qualify. This is going to be all in free to make it happen.
Yep. Should be interesting. A lot of valid points raised, and we'll keep an eye on it all. And Bill, I want to thank you very much for coming on.
Yes, thank you very much.
And yeah, we'd love to have you on again after the election to make sense of all that, regardless of which side wins. Certainly big implications for the housing market. So Rob, thank you as always. Good seeing you.
Be safe, you guys.
And to our attendees, thank you for joining us on the live. If you're listening to the podcast or watching on YouTube, we do this show live on Zoom every Thursday at 3 p.m. and 3 p.m. Eastern, and then it goes immediately to Pod and YouTube, where I know a lot of you guys listen and watch. Next week, Jim Parrott former Obama senior economic advisor, Teresa Bryce
So good.
Bigelow. We got Mark Calabria coming up. So a real great guest list coming up in between now and the election. And we appreciate you guys making time, part of your afternoon, to join us here today.
Thank you, Rich. Thank you, Bill.
All right.
Thank
Thanks,
you.
everyone. And
Appreciate what
we'll
you
see
guys
ya
do. Appreciate
next
it, boys.
Thursday at 3. And thanks again, Bill.
See ya.
All right.
Thanks
Take
all.
care, guys.